Welcome to We Build Great Apartment Communities, the only show dedicated to the process and strategies for transforming apartment buildings to thriving communities. I am your host, John Brackett, and welcome to the show. All right, everybody, this is John Brackett here, your host of We Build Great Apartment Communities. I have here another great guest, Jeff Greenberg. And Jeff's joining us today, someone who has experience as an operator, as a syndicator. So very excited to be able to have a conversation with him today and also bring some value to our audience. How are you, Jeff?
I'm doing fantastic, Jacob. Thank you very much for having me.
Not a problem. Not a problem. Thanks for joining us. Jeff. So let me give Jeff's background. Jeff Greenberg is an MBA since 2007. Jeff has been investing in multifamily real estate and student housing in various markets throughout the United States. He has extensive experience in all aspects of multifamily acquisitions and operations, and he currently focuses on underwriting, due diligence, and investor relations. Jeff also runs several real estate meetups and educates and mentors new investors. So he's currently the CEO and managing member of Synergistic Investment Group, which is an LLC. So, Jeff, welcome aboard. You know, we're excited to be able to dive into some of your experiences and be able to pull some lessons out to share with our audience here. We have, just a great group of people that listen to the show, and so we're really excited to be able to have a conversation about not only apartment buildings, but real estate investing.
Well, thank you, and I'm excited to be able to share whatever information I have, whatever knowledge I've gained over the years.
That sounds great. Jeff, I want to start here. I see that you've been involved in, projects that have been valued over about $30 million and roughly about 1,000 units over the course of your career in multifamily investing. That includes multifamily properties, of course, student housing. I know the market is shifting now, or it already has, and it's continuing to evolve. What are the differences that you see between when you first started and what's going on right now? What are some of the key differences?
Well, there's a lot of similarities, I'm afraid. That when I first started, we were, I guess, in the recession. I don't know if it hadn't really hit multifamily yet. It was your single family homes. There was a lot of foreclosures going on. So I don't know that we're quite there yet, but it is certainly a possibility that we're going to be getting there. But it's was beginning to be a buyer's market, but I didn't have the knowledge or the information to realize that. I didn't realize what an opportunity it was at that time.
Interesting. So, when you look back in hindsight, when you're actually, when you're very active at acquiring properties and underwriting, what are some of the changes that you're making right now to, how you're underwriting your properties based on, just this new market that we're coming into?
Well, the market we're coming into right now, especially with the COVID still out there, the main thing we're looking at is the downside. You're always looking at the upside and how much you can offer to your investors. But right now we're looking more about, okay, how low can the occupancy go and we can still pay the bills? How much money should we continue to keep on reserve? What if we can't raise rents? What if we're not able to raise the rents? What if the cap rate is expanding and the values are decreasing? What are we doing to protect ourselves? And do the numbers still work even with all those precautions?
Yeah, I really appreciate you saying that. I think it's really easy when the markets are roaring and there's a lot of demand out there for product, in this case, multifamily product. But now that we're coming into a different market and we have to start underwriting to risk, I think for a lot of investors out there, that's going to be something new that they have to start really considering. And in your experiences, Jeff, are you starting to see maybe some of the lofty projections that were being made starting to come under scrutiny with investors?
Well, yeah, it's tightening up quite a bit, that people are more concerned about it, and they want to have what we call a sensitivity analysis as far as, what if your projection's off by certain percentages? What is that? Are we still going to be able to break even? The number one thing is protecting investors' funds, and then, after that, then you hope to make them money. But the first thing is to protect their investment. So you're always looking to make sure that the downside is protected.
Sure. And, you gave a couple of metrics on how you're assessing risk in this market. Are there any, what are maybe the overriding key metrics that you're really paying very close attention to right now as you're starting to, assess some of these projects?
Well, a lot comes, there's several. One, you don't want your debt to come due while you're in the middle of a downturn. So you're going to be looking for a longer-term debt. You don't want debt that you're going to have for 3 years, which you don't know where we're going to be in 3 years. But longer-term debt, making sure you don't over leverage. Be concerned about the economic occupancy as far as if occupancy goes down. We've got a very high unemployment right now, so we certainly want to be concerned about that. So those are the main ones, making sure that you have sufficient reserves.
Sure.
I've seen some underwriting from deal sponsors where, they have a limited amount of reserve. And, I look at it and say, well, wait a minute, that's not enough if something happens. And, the better ones are going to say, oh, yeah, well, we have, here it's in another spot and here it is. And I say, oh, okay. They have another $600,000 sitting over here that makes up for the $250 a door that they were, put in as capital reserve, but they do have other funds reserving. So it's just, making sure that you're preparing more for the downturn or the downside, as opposed to always looking at the upside.
Sure.
We work so hard to find deals that work, and the newer investors fall into a trap that you're trying so hard to make something work. It's always good to have somebody else look at it, somebody that hasn't spent any time on it, hasn't worked on the project for a year, and say, here, look, do these numbers work? What do you think about these numbers? And that's something I do a lot of, is looking something over, with nothing invested in it, so I don't have to try to make the numbers work.
Yeah, you know what? That's a really great point. The term that I hear out there in the marketplace, and what I speak with my team about, is we can't get emotionally involved in our projects, right? Mm-hmm. We have to make decisions independent of, how we feel about something. we have to make decisions, primarily based on just the economics of the project. So how do you maintain that discipline?
Well, that's tough if you're the one that's spent all the time in it, but you do have other team members that look over things and are able to say, hey, yeah, I agree with this, or I don't agree with this. The other thing is you could take it to your property manager that they're looking to hire for that particular project. Let them look it over. The other thing is if you have a mortgage broker, you give the numbers to the mortgage broker. The mortgage broker could look it over. But you want somebody else to look at the numbers and let you know, if the numbers look good. Property manager will give you more information about the property and the location and the market and all that good stuff. But to confirm that you're on the right track.
Sure.
And
sure.
Typically we don't put much weight on what the broker says. The broker wants to make a sale.
Sure. So we just talked a little bit about acquisitions. Now I'm going to move us into the realm of financing, right? So inside of our business, we break we break this cycle up into really 5 quadrants. In this case, I'm going to talk predominantly about 4. First one is, acquisition. Second, financing the project or capitalizing the project. Third is managing it. And lastly, disposing of the asset. The 5th component that we add as a business is customer service, right? Or actually running a business. So I'm going to move us into right now and take our audience with us into financing. And so you and I talked earlier before we got on the show about you making a shift. And I think, a lot of it is you seeing a very unique opportunity, especially with your experiences and your background. Can you talk a little bit about financing and the importance of capitalizing projects correctly, properly?
Well, I could talk about the equity side of it.
Sure.
The raising of funds from investors, because typically all the deals we're dealing with are syndicated deals, or there are some that you could do as far as joint ventures. But basically as the equity raise, I talk to a lot of investors that are looking for either a diversification of their portfolio or looking for another place to put their funds. And it's my service that I do is to vet the deal, vet the sponsor. The sponsor is very important to look at when you're looking at a deal. Too many people just jump right in and start looking at the deal. I don't even look at
Jeff,
the deal at all.
Can you talk a little bit about that? So, when you talk about the sponsor is a very critical component to the investment. Can you talk about what do you look for in a sponsor?
Well, I look for a sponsor that's got a team together that has a track record, that has been performing over a certain amount of time. Preferably, they've had some ups and downs, or they've been in the different markets where they've seen the downturns. I want to see conservative underwriting. I like to go and see, meet with them if it hasn't been somebody that I've known for a long time. See how they run their office, just to understand, exactly who they are. See if we're on the same page morally and ethically. How they run their businesses, and to be able to talk with people that they've worked with, either vendors or other investors that they've worked with. I want to know something about the team. I want to know, what's going on, that it's someone that I want to be able to deal with and that I can trust.
Yeah, you know what's really interesting, Jeff? I asked this question to many people, right? Because for me, it really helps me understand, how that person is thinking about investing. And what I find really interesting is I've asked this question literally almost every time with various people that I interact with in this business. And the one thing that I never get, the answer that I never get is, asking for a credit report and their personal financial statement. And here's why I do that, right? I mean, I get people soliciting us for deals all the time, at least maybe two opportunities a week minimum. And some of these deals are actually are pretty decent deals, right? But what's really interesting is, for our investors or people that come to me and want to participate in investments with me, the very first thing I do is I have no problem giving them my FICO score, right? That's the first thing. The second thing is I have no problem. I always have available my personal financial statement. And here's why I do that. And here's why I think that's really important, because at that point you get right to it, right? Okay. You really do. Banks require that of you and I as sponsors. The crazy thing is I don't understand why people don't expect that of other sponsors, because just because you can manage many, many assets and you have 1,000 units under management or 2,000 units under management, that doesn't mean that doesn't mean you know how to build wealth, right? It doesn't mean that at all. A lot of times those deals are capitalized inadequately, and the way that the fee structures are set up, they can really impact an investment significantly. And so I find that very, very interesting. But that's something that I expect even when we're joint venturing with any group, whoever the sponsor is, I want to understand what their credit standing is, what it looks like. And I also want to understand how they've been able to build wealth, right? Because if you're going to deploy my capital, it doesn't make sense for me to bet on a horse that has never made the kind of money that they're telling me that they're going to make in their projections.
Mm-hmm.
I mean, intuitively, it doesn't make any sense.
Excellent point.
Yeah. And so for me, that is standard when we're communicating with our investors or folks that want to invest with us or people that we want to JV with. Those are the very first two things that I ask for. And if people are unwilling to provide that information, we quickly move on, because that's our very first vetting criteria, right?
Mm-hmm.
You know, if you can build wealth, you know, let's get beyond these first two preliminary discussions. One is, you know, your character, your credit report. Number two is you're demonstrating to me that you've built wealth before and you know how to manage money. One of the things that I've learned in this business is human beings for the most part are just not that disciplined, right? The way that we manage our money is typically how we're going to manage someone else's. It's just a fact. I've never met anyone that did a horrible job of managing their own money, but an amazing job of managing someone else's. Have you?
Well, I don't know.
I personally have never met anyone like that.
Yeah, I probably don't know that if I have or not, because I haven't gotten into that, that close of detail. But, typically people will take a lot more risk with their own money than they will with somebody else's.
No, that's a great point. So I really appreciate you commenting on that, but I'm pretty passionate about that topic because in all the discussions that I participate in around qualifying sponsors, very, very rarely do I hear those two things. And those two components will tell a lot about a sponsor in a matter of minutes, right? Within 5 minutes. I mean, you'll know a lot about, who that person is, in really just a couple minutes, right? 2 to 5 minutes. So I really appreciate that comment. So where are you seeing some of the opportunities now, especially with COVID? And of course, we're moving into, I think a cycle right now where I don't think it's a secret that there's the perception right now that it's a buyer's market, right? Most sellers may not feel that, depending on the asset class, very different story. But the perception right now is, of course, it's a buyer's market. I think the longer we stay in this cycle, the more of a buyer's market it's going to become. But where do you see the opportunity based on where we are today in the cycle?
Well, I agree with you that I think that we're going into the buyer's market. I think sellers that need to sell or really want to sell, that they're highly motivated, will give some kind of concessions. I happen to be in the middle of a raise now on a deal where they were given an 11% concession on their original price pre-COVID. And that 11% was a little over $2 million. So that's pretty significant. And they required that in order to reduce their perceived risk, and go in continuing into the deal. So those are happening. You weren't seeing that pre-COVID. You were seeing a lot of, it was a seller's market, and there was plenty of people that will come in with the price if you didn't want it.
Interesting. So can you walk us through, when you talk about that $2 million discount, and the reason why that was negotiated is to offset their perceived risk, can you walk us through how that translated into the risk associated with the deal? For example, did that $2 million price, how was that justified, right? Was it, okay, well, right now, because there's greater uncertainty in our ability to collect rents, right, that's increased our expense ratio, and therefore NOI has gone down, and consequently, valuation, we feel that it's a lot less than what you're asking for? Or are they requesting that in an expansion of their cap rate because they feel like, right, it's warranted, which really would be built in if you're doing the analysis. But can you help maybe walk us through that so that our audience understands why this is such an important conversation about the discounting of price in a market like this?
Well, I can't tell you about how, what were the total reasons on this particular deal. I didn't have the lead on that, and I wasn't negotiating that reduction. But just by assumption, several of the things that you said would be correct, is that the perceived risk that, occupancy would be going down, and the fact that people right now may be able to pay their rent because of a lot of the government stimulus. But down the road, we don't know. We don't know what happens when the stimulus stops and people aren't able to pay their rent. They're, maybe now unemployed. And so that has increased the perceived risk. And what the lower price does is it lowers, lowers your debt service. It allows you to raise, if you raise the same amount of money, you can have additional money on as reserve. It's going to reduce where your stability is going to be, where your break-even point is going to be on occupancy. Sure. So by lowering that cost, that's, reducing the risk quite a bit. If you could get that break-even point a lot lower on the perceived risk. And getting the price reduced is just one point. I mean, I know other people that have been able to negotiate a escrow account,
reserves,
that would guarantee a certain occupancy level. And if you didn't reach that occupancy level, you could dive into the escrow account. So there's other ways of doing it in this, higher risk period of time.
So, what's really interesting about what you said, Jeff, and I really appreciate just some of the conversation about the different ways to mitigate risk, right? I think in my experiences, coming into these markets that are volatile creates a massive amount of opportunity, but it takes people who know how to look at opportunities differently and ultimately find different ways to mitigate risk, right? And so in my world, we call them deal makers. And, in this business, usually they're the folks that have been around for quite some time that are very seasoned. You don't hear about them a lot, but, they're people, like you, right? Putting together these transactions and finding ways to still make the deal work, but you might be approaching it a little differently than, the typical investor. Can you talk a little bit more about, how that's going to impact an investor's ability to not only get deals done, but to get them done in a manner that not only satisfies what some of the seller's requirements are, but also appeases to, his investors, right? So hits his target returns, but also mitigates risk. Because one of the things that I always am attracted to is deal structuring. Right? Mm-hmm. Deal structuring, I find that the more challenging the market, the more opportunities are created by folks that just have a lot of exposure to putting together deals. And so what are your thoughts on that?
Well, I can relate back to my first business partner. She was extremely conservative, and she would go and, look at a deal, underwrite the deal, and said, the deal doesn't work. And I would typically go and say, okay, is there a way that the deal could work? Is there some structure? Is there something that can be done that the deal would work and we would be able to, make money for the investors, but it would still not be adding risk to the investment. And, we made some attempts at, master leasing a property just to prove out our our theory that rents can be increased and without taking as much risk as purchasing the property
Sure.
or getting owner finance or whatever it may be to reduce some of the risk. But I think that deal makers, the thing is they're troubleshooters. They have to look at something and see if there's a way that a deal can work. Now, I'm not saying squeezing the numbers and pushing the numbers to their limit kind of thing. Is there a way that something can work? And I mentioned one that we were looking at a student housing property a while back, and there was a new property that was just built right next to it, and it was newer and prettier and bigger and the whole bit. And so the property we were looking at was having trouble leasing up because of this new, bigger, beautiful property coming in. And we were talking to them about, an escrow, in case that the property wasn't able to get to the occupancy that we were underwriting at. We ended up walking away from it, even though they were willing to put some money aside for us. It was going to take, more than 1 year before this was going to balance out and we were going to be able to get the occupancy, because this other property, was physically right across the street and it had more amenities than us. So we just said, nah, this just isn't going to work. But we did, look at some options to see if there was anything that could be done for it.
One of the things that I do that I find very helpful is I ask the seller or the broker. I always ask, hey, well, what are your ideas? When we're at a junction in being able to come to terms or solve a problem, I like to involve the seller in helping to solve that problem, because once they're engaged, typically there's a lot more movement. If I'm the only one proposing solutions, we typically stay stagnant, or at that point I'm spending all my time and energy trying to solve someone else's problem. And that's usually, usually not a good thing. I always say I'll help you solve your problem, but I'm not going to assume it.
Right. Sometimes the difficulty is to get actually, in contact with the seller. A lot of times you're dealing directly with the broker. Right. The broker is very protective. So sometimes you're going through them, which, sometimes can be a problem.
Yeah. Well, I really appreciate the comment. So last, I know we're not going to be able to get to dispositions, but really briefly, management. I know, as operators, management is a very critical component, of, being successful in this business, because, if you're coming into an asset with a business plan, ultimately your ability to execute and our ability to execute on that plan is really where we make our money, assuming that we're buying right? So, just really quickly, can you touch on management right now in this market and maybe some really big things for us to keep our eyes on?
Well, first, let me mention that I'm glad that you brought operations up, and I'm also glad to see that there's a lot of podcasts out there that are talking about asset management and operations and what to do afterwards. When I was first, starting out in this, all you heard was, how you acquire the property. And then, once you've acquired the property, you jump up and down and celebrate and say, all right, we did it. And then you think, oh, wait a minute, we just started. Now we got to go to work. So I'm glad that a lot of that has changed, and I see a lot more people talking about operations and that. And anyway, to answer your question, the operation of a multifamily, if we're talking about 100 plus units, I'm probably not talking about some of the smaller ones, but typically you've got whoever is your asset manager, and it may be your deal sponsors, or it may be somebody else that is doing the asset management, but somebody in between, somebody that's dealing directly with the management company. Management company is absolutely key. People don't give enough credit or concern about the management team. They'll make or break your deal. I mean, there's, several times that I've had management companies that almost broke my deals. It's important that you have a management company that is on your side, that it has the same motivation, or you need to, help them be on the same path. And the asset manager is essentially the one that's going to be, watching over them, maybe not day to day, but, just pretty much looking at the documents, the reports, meeting with them, a constant process. And, like I said, it could be the deal sponsor that's that asset manager. It depends. Once you get enough properties, that gets to be pretty time consuming.
So you said something that really caught my ear, which was, a property manager at one point almost broke your deal, right? And so can you share that experience with our audience? Because I've learned that inside of these challenging moments is oftentimes where we grow the most, but there are a lot of lessons and there are a lot of nuggets. So some of the key distinctions would be what?
Well, the one that I could think of is our first property that we ever got, which was a few years back. It was a 20-unit property, and my broker that had brought me the deal wanted to manage it, so I let him manage it, and that was a huge mistake because that was not his primary source of income, and because the property was about 35 miles away from where his main business was, he let it slack. And this was a property that was 3 years old. It was down the street from a hospital, and it was 100% occupied when we took it over. But it was taking too much of his time. If he had to drive down there to show the property, anybody that showed up and would fill out an application, have the deposit, they were in there. It didn't matter that they weren't qualified. It didn't matter that they were inappropriate for that building. But he let them in, and we started to find that the people that were appropriate for the building, that were the good quality tenants that we wanted, were getting, were leaving because they didn't like the neighbors. So we ended up, out of the 20 units, we ended up down 6 before we kind of, threw in the towel and had to get rid of them.
Sure. Interesting. So if you had to share a lesson learned from that experience, what would that key lesson be?
Fire your property management quickly. Hire slowly, fire quickly.
Oh, that's good. That's great.
Don't wait as long as we did. We waited way too long to get rid of them.
Well, Jeff, I really appreciate you being on the show. You've been a great guest. You shared some great information, and your years of experiences have been able to provide I think quite a bit of value. I have about a half page worth of notes, so I'm sure our audience has at minimum at least that, right? So Jeff Greenberg, thank you so much for being on the show. For those people that want to reach out and contact you, what would be the best way that they do that, Jeff?
Well, they could do it on my website, which is synergetic.com. And Synergetic is SYNERGETIC.IG.com. Or reached out to me at jeff@synergetic.ig.com with the same spelling.
Really appreciate that. I am John Brackett, your host. We build great apartment communities. We are very happy to have Jeff Greenberg on the show. He shared some great information about moving through this market, different ways to underwrite, capitalize your projects, and more importantly, some really important things to consider, after you acquire the asset and now you actually have to manage it. Management is one of those things that I think are, to your point, Jeff, I don't think maybe appreciate is not the right word, but not talked about as much. But of course, once you acquire, an asset and you have to manage it, it becomes really important, right? But at the end of the day, I think success is only as good as our ability to execute and create results. And so for me, management is critical. And so therefore, I appreciate you sharing a story about that. And, we look forward to having you back at some point.
Well, thank you very much. This has been my pleasure. I always enjoy talking to people, helping in any way that I can.
Really appreciate that. Thank you so much, Jeff. Great having you on the show. Clarity of purpose creates our greatest competitive advantage. When we transform apartment buildings to thriving communities, we improve how people live and create assets with high profit margins. Don't forget to subscribe, like, and share this up with a friend. I'm John Brackett, bringing you things you can implement right away.